The European Central Bank's May 2026 report opens with numbers that look reassuring. Bad loans across euro area banks are at a historical low, 2.2%. Bank returns remained close to 10% in 2025. Default rates fell across most major industries. Then, a few pages later, the report shows investors asking a group of private credit funds for more than $20 billion back in a single quarter. The funds honored roughly half of those requests. Cash holdings inside major investment funds had also been falling. Strong bank numbers on one page, investors crowding an exit on another. The ECB lays out the path it is watching. An outside shock hits markets. Funds short on cash begin selling. Pressure then moves through banks, companies, and households. So the next financial shock may reach the banking system without starting there. The question is, what happens before it arrives?
A crisis does not need to begin with a failed lender. The trigger could be an oil shock, a war, a trade disruption, or a cyber attack. The geopolitical risk chart in the report rises sharply. Oil volatility rises alongside it. That feeds into the price of transport, electricity, and manufacturing. Companies lose some control over their costs. Households have less left after paying for essentials. The ECB's forecast chart shows the uncomfortable combination that follows: more risk of higher inflation and weaker economic growth. Central banks then have less freedom to cut interest rates. Borrowers who were counting on cheaper money have to wait. Some of them have already been waiting for years.
These shocks arrived while large parts of the market were already expensive. The ECB tracks energy shares, software companies, interest rate expectations, and government bonds. They are different markets, but they had all been priced around assumptions that could change quickly. Energy shares rose as the conflict pushed fuel concerns higher. Software stocks moved the other way. Investors were trying to work out which companies would benefit from artificial intelligence and which business models might be damaged by it. That split matters here because software is a large part of private market lending. A lower share price does not make a company insolvent. It does make investors less willing to assume that future growth will solve every problem. Debt markets were also changing their mind. Expected interest rates moved higher. A company planning to refinance at a lower rate now had to consider paying more for longer. Nothing is broken at that point. The borrower just has fewer good options.
Put those market moves beside the banking data, and the picture becomes odd. The overall bad loan ratio is still 2.2%. Defaults have fallen across most broad industries, but the smaller business data do not look as clean. Default rates remain above their post-pandemic levels, and some countries are moving in the wrong direction. Germany stands out in the ECB's country chart. Commercial property lending shows a similar split. The total picture has stabilized. Individual countries still have very different amounts of property exposure and very different levels of troubled loans. Consumer credit is not collapsing either. Its bad loan ratio sat near 5% between 2023 and 2025, with a gradual rise rather than a sudden jump. So recognized bank losses remain low. The strain is showing up earlier in the process. Companies paying more to borrow, funds holding less cash, and investors becoming less willing to wait. Bank regulation became much stricter after 2008. Banks had to hold more capital and keep larger liquidity buffers. That made them harder to bring down. It did not remove the demand for loans. Businesses still wanted money. Investors still wanted returns above what ordinary bonds were offering. More lending moved into private credit funds, insurers, and other institutions outside traditional banking. That is the part of the system the withdrawal chart captures. In the first quarter of 2026, investors in a sample of 26 private credit funds requested more than $20 billion. Only around half was honored. The ECB says some of those requests were pushing the fund's contractual withdrawal limits close to their maximum. The funds still held assets. The trouble was turning those assets into cash without selling them cheaply. Take a fund with $100 in assets. Maybe $5 is held as cash. The other $95 has been lent to companies. Then investors ask for $15 back. The fund can pay the first $5. After that, it needs another source of money. It could borrow, it could sell a loan, or it could limit the withdrawal. Selling a listed stock is usually straightforward. There is a public price and a stream of buyers. A private loan may have neither. The fund might value that loan at $100. That does not mean someone will pay $100 for it today. If the fund needs a buyer immediately, the offer could be $90. It could be $80. It depends on the loan and how nervous the market has become. Accepting that price turns an estimated loss into a real one. Refusing it leaves the investor waiting. That is how a fund can show billions in assets and still struggle to meet a rush of withdrawals. The report then points to a second problem inside those loans. A company owes $1 million in interest. It does not have the cash. Instead of missing the payment outright, the interest is added to the amount it owes. A $10 million loan becomes an $11 million loan. This is called payment-in-kind interest. It can be useful when a sound company has a temporary cash shortage. The arrangement buys time. But the fund receives no money. The borrower avoids an immediate missed payment, while the lender may continue recognizing interest income. Now, bring back the investor asking for a withdrawal. The account may show income. The loan balance may have increased. Neither one puts cash in the investor's hands. By the third quarter of 2025, payment-in-kind loans made up roughly 13% of the relevant loan assets in the ECB chart. The share was higher among software-related borrowers. Those companies were already dealing with weaker valuations and uncertainty over what AI might do to their revenue. The borrower sends another IOU. The withdrawal request still arrives in cash. This is where redemption gates come in. A gate limits how much investors can take out during a given period. It may feel like the fund is simply blocking the door, but there is a reason for it. Suppose the first group of investors forces the fund to sell its best loans at a steep discount. The people who remain inherit the damage. Slowing withdrawals can stop that from happening. The cost lands on the person trying to leave. Their statement may still show the same balance, while part of the withdrawal gets pushed into a later quarter. A fund is therefore making two promises. One concerns the return. The other concerns access. Those promises become harder to keep together when the investments last for years, and investors want money back in weeks. Pressure in a private fund does not automatically crash the bond market. The connection comes through investors that operate in several markets at once. Pension funds, insurers, and large investment firms can own private loans alongside public bonds. When they need cash, they tend to sell whatever has an active market. That may be a government bond or a publicly traded corporate bond. The bond gets sold because a buyer exists, not because it caused the original problem. The ECB's cash buffer charts show less room for maneuver than there used to be. Euro area bond funds held a little under 6% of their assets in cash in early 2020. By early 2026, the figure was around 4%. Equity funds also reduced their cash holdings from roughly 4% to around 2%. During the market turbulence of April 2025, withdrawals from high-yield bond funds were larger than their average cash buffers. Once the cash is used up, another withdrawal requires a sale. If several funds sell similar bonds together, prices start moving. Some hedge fund strategies hold around $25 in assets for every dollar of their own capital. The rest is financed with borrowed money. This can work well when prices barely move. A small profit on a large position produces a strong return on the fund's actual cash. The same structure becomes difficult when the trade moves against them. A falling bond price reduces the value of the collateral supporting the loan. the lender asks for more. The hedge fund may be certain that the bond will recover next week. It still needs money today. So it sells. Other funds see lower prices. Their collateral is marked down as well. They receive their own demands for cash. Withdrawals lead to bond sales. Bond sales create collateral calls. Those calls bring more bonds onto the market. Nobody needs to believe the assets are worthless. They only need to lack enough cash to hold them. Banks enter the chain through lending and collateral, but that is only half of the connection. Funds also supply banks with money. They hold deposits and provide short-term financing. The ECB's balance sheet chart shows euro area banks owing more to the non-bank financial sector than they lend directly to it in aggregate. So when funds pull back, banks can lose a source of funding. A bank facing that pressure will usually become more selective. It can reduce credit to hedge funds, raise collateral requirements, or lend less to companies. That response may be perfectly sensible for the bank. For everyone needing to refinance at the same moment, it is another closed door. The banking system can remain well capitalized while making the squeeze worse. The ECB maps the business sectors most exposed to trade, energy, and interest rate shocks. Manufacturers face higher energy costs and weaker overseas demand. Construction companies depend heavily on financing. Retailers feel the change when households cut spending. Consider a company refinancing $100 million of debt. At 5%, it pays $5 million a year in interest. At 8%, it pays $8 million. The additional $3 million has to come from somewhere. The company might postpone new equipment. It might cancel an expansion or leave positions unfilled. That is how a liquidity squeeze moves out of financial markets. The original problem might have been a withdrawal request inside a fund that most people have never heard of. The effect can appear later as a rejected loan, a weaker pension portfolio, or a job that is no longer being hired for.
The ECB is not saying that a financial crash has begun. Markets have continued to function. European banks have substantial capital and liquidity. Private credit is smaller in Europe than it is in the United States. Many European private credit funds also lock money in for longer, which reduces the chance of a sudden wave of withdrawals. Redemption gates can make the system safer by preventing rushed sales. Those protections are real. The report is asking how they would hold up if several pressures arrived together: expensive assets, hard-to-sell loans, leveraged trades, and investors wanting cash. That combination has not produced a crisis. It has produced a reason to watch the exits. Bank losses can remain low while pressure builds elsewhere, because a bad loan is often a late signal. Before the default comes the refinancing problem. Before the forced sale comes the withdrawal. Before the withdrawal comes the assumption that the money will be available whenever someone asks for it. Private loans take time to repay. Some borrowers are already paying interest by adding to the debt. Funds hold less cash than they once did. Leveraged investors cannot always wait for prices to recover. After 2008, everyone learned to search for the bank with the worst loans. A better question for the next shock may be simpler. Who needs cash first? A statement tells you what an asset is valued at. It does not tell you what price someone will pay during a sell-off, or whether the money can reach the exit before the gate closes. The spreadsheet can wait. The cash request cannot.